Picture this, a crowded Amsterdam tavern in the winter of 1637. Candles flicker. Merchants shout over one another. On the table, there's no gold, no land deeds, no ship's cargo. Just a slip of paper with the name of a flower. A tulip. One rare bulb, never seen by most of the people bidding, sells for more than a small house. Tomorrow, they're sure, someone will pay even more. Everyone agrees. This is the smartest trade they'll ever make. Now jump forward. It is 1999. A 20-something in a tiny San Francisco apartment clicks buy on a website that sells dog food with a sock puppet mascot. The company has never made a profit. It might never make one. But its stock has doubled, then doubled again. CNBC calls it the future. His friends are all in. He tells himself, I'm not crazy. The old rules don't apply anymore. Fast forward again. A teenager, phone in hand, on a free trading app. Meme stocks, tech stocks, crypto. Screens full of green candles and rocket emojis. He's never read a balance sheet. But everyone online seems to be making money. It always dips, then explodes, they say. Don't get left behind. 3 centuries, 3 different technologies, 3 completely different worlds. And yet, if you strip away the tulips, the .com logos, the slick trading apps, you see the same skeleton underneath. A story that excites people. A new thing nobody fully understands. Easy money, then FOMO, then leverage, then denial, then silence. The assets change, the math does not. That's what this story is really about. From tulips to tech stocks, from South Sea shares to subprime mortgages, financial bubbles always dress up in new costumes. They attach themselves to whatever the next big thing is. Flowers, canals, railways, radio, the internet, housing, AI, crypto. But under the surface, they follow the same script. Let's go back to the Dutch Golden Age and sit in those smoky taverns. In the early 1600s, the Netherlands was one of the richest places on earth. Dutch ships crisscrossed the globe. Amsterdam's canals were lined with merchants' houses. Trade, finance, and science were booming. Into this world, tulips arrived from the Ottoman Empire. At first, tulips were rare, exotic, a luxury only for the elite. They weren't just flowers, they were status symbols. A unique, beautifully patterned bulb in your garden was like a custom-painted supercar parked outside your house. Some tulips carried a natural virus that made their petals streaked with vivid flames and stripes. These broken tulips were incredibly unpredictable and incredibly desirable. You couldn't simply grow more of the exact same pattern. That rarity triggered something deep in the human brain. If there aren't many, it must be valuable. At the beginning, people just paid high prices for rare bulbs. Still crazy, but not yet a bubble. Then one thing changed that would echo through history. People started trading contracts for tulips that didn't exist yet. Instead of handing over a bulb, they wrote pieces of paper. I promise to deliver this bulb next spring at this price. These contracts started trading in taverns and on street corners. You could buy and sell the right to a tulip hundreds of times before the flower ever touched soil. That was an early form of derivatives trading. Once you move from, I love this thing, to, I think I can sell this thing to someone dumber later, you have all the ingredients of a bubble. Word spread. A man sold a single bulb and bought a house. A carpenter traded his tools for options on tulips. Housewives, sailors, servants, people who had never invested in anything, started jumping in. Prices went vertical. No one was valuing tulips based on beauty anymore. They were valuing them based on the expectation that the line would keep going up. The story wasn't, these flowers are rare. The story became, you can't lose. Everyone's getting rich. This is the first stage of every bubble. A plausible story becomes a money story. Tulips really were beautiful. The internet really did change the world. Houses really are useful. AI really can transform industries. The story starts in truth, then leverage, greed, and imitation twisted into something else. In the Dutch taverns, deals were scribbled on scraps of paper, often with no witnesses, no margin, no collateral. Buyers were on the hook for huge amounts of money if prices fell, but most people never imagined that could happen. Until it did. One day, at an auction in Haarlem, bids were lower than expected. A seller refused to accept the price. The mood shifted. People looked around and thought, if he won't sell, Maybe he's scared. If he's scared, should I be? Confidence, that invisible glue that holds every bubble together, began to crack. In a market built entirely on the belief that someone else will always pay more, even a small doubt can be fatal. In a matter of weeks, prices collapsed. Contracts written at sky-high levels were suddenly worthless. Many participants refused to pay what they had promised. Legal disputes erupted. People who had thought they were rich realized they had claims on paper, not actual money. Tulips hadn't changed. The story had. That's the key. The underlying object, a bulb, a stock, a house, often remains exactly what it always was. What changes is our collective belief about what other people will pay for it. Tulip mania is often exaggerated in popular retellings. Not everyone went bankrupt, and the Dutch Republic didn't collapse. But as a psychological blueprint, it's almost perfect. A new, exciting object, a small, elite market. Price rises, create stories. Stories attract outsiders. Paper contracts replace real assets. Leverage appears. The line goes vertical. Then one day someone hesitates, and the crowd turns. Now step forward in time. The 18th century. The South Sea bubble in Britain, the Mississippi bubble in France. Different details, same pattern. A company promises to solve government debt through clever financial engineering and trade with distant lands. Shares explode in price. People pawn their furniture to buy in. One promoter advertises a company for carrying on an undertaking of great advantage, but nobody to know what it is. Investors throw money at it anyway. If that sounds like a meme coin or some AI token with no product, you're not wrong. Jump to a more modern example, where the numbers get bigger and the consequences much worse. The stock market boom of the 1920s. America in the Roaring Twenties felt like a country that had hacked the future. Cars on the roads, radios in homes, electricity spreading, skyscrapers rising, productivity was climbing. Corporate earnings were growing. People genuinely felt, we've entered a new era. Stocks responded. At first, the rise matched real progress. Then something new entered the game, margin debt. For the first time, ordinary investors could borrow heavily to buy stocks. You put down a small amount of cash, the broker lent you the rest. If the stock went up, your gains were magnified. If it went down, well, who worried about that in a raging bull market? Newspapers glorified stock market heroes. Cocktail parties buzzed with ticker symbols. Elevator operators and shoe shiners proudly talked about their portfolios. The idea that the market only goes up in the long run took root. Even respected economists said things like, stock prices have reached what looks like a permanently high plateau. Every bubble produces some version of that sentence. Permanently high plateau. New era. This time is different. It is always the same emotion. The belief that the old rules don't apply anymore. Underneath, the same mechanics from the tulip days were still working. Borrowing to buy. Rising prices attracting new buyers. New buyers pushing prices higher. Higher prices used as proof that the story is true. A feedback loop. Of course, the market did not stand on a permanently high plateau. When confidence cracked in 1929 and people began selling, the same leverage that had amplified gains now amplified losses. Margin calls forced selling into a falling market. Banks that had lent against stocks were in trouble. The crash spilled over into the real economy. Once again, the asset, shares in companies that made cars, radios, appliances, had not suddenly become useless. But for years, investors had paid any price for them because they believed there was always someone else more optimistic. Once that belief died, so did the bubble. Now jump to the late 1990s. The dot-com boom. The internet was real. It was big. It was going to change everything. On that much, the optimists were right. But markets have a way of taking a good story and turning it into fantasy. Startups with no profits and sometimes no revenue went public with billion-dollar valuations. Business plans were PowerPoint slides and buzzwords. Online. Portal. Eyeballs. Synergy. Analysts invented new metrics, not earnings, but eyeballs, clicks, page views. Companies spent millions on Super Bowl ads before they had a working path to profit. Investors made the same mental move the tulip speculators had made. They stopped asking, what is this worth? and started asking, "What will someone pay me for this next month?" People quit jobs to day trade. Taxi drivers gave stock tips. Financial TV ran 24/7 coverage of tech stocks. Every pullback was seen as a buying opportunity. Those who warned about valuations were mocked as dinosaurs who didn't get the new economy. Behind the scenes, once again, leverage and derivatives were growing. Once again, the idea that this time is different took hold. Once again, a new technology was treated as if it could abolish the old math of cash flows and profits. Then, as always, reality called. Companies burned through cash too fast. IPOs disappointed. A few high-profile bankruptcies shook confidence. Investors suddenly remembered a very old question. When will this company actually make money? Just like the Harlem auction in tulip times, the first failed offerings and disappointments triggered doubt. Doubt turned into selling. Selling turned into a rush for the exits. The same names that had been on magazine covers became punchlines. Lives were wrecked. Some companies, the Amazons of the world, survived, even thrived later. Many others vanished. What died was not the internet. What died was the story that fundamentals don't matter anymore. That story dies in every bubble. Then slowly, it's reborn around some new asset. Now the housing bubble of the 2000s. If tulips were about luxury and dot-com stocks were about the future, houses were about something deeper. Safety. For decades after World War II, buying a house in many countries really did look like a one-way bet. Prices dipped occasionally but tended to rise with inflation and growth. Owning your home wasn't just a financial decision, it was part of the social contract. Banks and governments encouraged it. Tax rules favored it. Ordinary people saw their parents buy a house, pay it off, and retire with equity. Real estate agents repeated the same mantra. They're not making any more land. Housing always goes up in the long run. Then interest rates fell. Mortgage products got more creative, then more dangerous. Instead of simply lending to people who could reasonably repay, the system shifted toward lending to anyone and repackaging those loans into complex securities. The crucial pivot in every bubble. Risks stop being confronted and start being sliced, wrapped, and sold. Banks bundled thousands of mortgages together into mortgage-backed securities. Then those were sliced again into tranches with different levels of risk and return. Rating agencies stamped many of them AAA. Pension funds, insurance companies, and investors around the world bought them, reassured by the idea that housing across the whole country could not fall at once. Homeowners believed their house was an investment that could only go up. Lenders believed they could always refinance or foreclose. Wall Street believed its models. Everyone believed the same story. Housing is safe. Spreading the risk makes it safer. The old rules of credit cycles have been tamed. Once again, leverage crept into every part of the system. People borrowed against their rising home equity to consume more. Banks borrowed short-term to fund long-term mortgages. Hedge funds borrowed to lever up mortgage bets. Whole institutions were balanced on thin layers of capital. Then, as always, the story met a limit. Interest rates rose. Some adjustable-rate mortgages reset higher. Borrowers who had been stretched to the max began to miss payments. In a few regions, prices stopped rising. The assumption that you can always refinance or sell at a higher price stopped working. It was the tulip auction again, blown up to suburb scale. A few hedge funds that specialized in mortgage securities blew up. That shook confidence in the pricing of these complex products. No one was sure what they were worth anymore. When you don't know what something is worth, you don't want to lend against it. Funding dried up. And once again, the same old movie rolled. Forced selling, margin calls, liquidity evaporating. Assets that were safe suddenly aren't. Institutions once thought unshakable, revealing how fragile they really are. Housing didn't stop being useful. People still needed somewhere to live. What collapsed was the belief that you could load the housing market with infinite debt and never face a reckoning. From tulips to South Sea shares, from radio stocks in the 1920s, to dot-coms from McMansions in Florida, to meme stocks on your phone. This is the repeating pattern. A new story makes people feel like the old limits don't apply. A small group of early insiders make genuine money. Their success is broadcast and exaggerated. Outsiders flood in, motivated not by understanding but by envy and fear of missing out. Leverage appears, so people can participate with money they don't really have. The market stops being about the thing itself and becomes a game of guessing what other people will believe tomorrow. Any warning is dismissed as negativity. Then, often from a small trigger, the mood flips. Why does this happen over and over, across such different centuries and technologies? Because bubbles are not about assets, they're about humans. We haven't changed. Our brains are still wired for tribal status, envy, copying successful people, and telling ourselves stories that justify what we want to do. In every bubble, three psychological forces team up. First, the seduction of the new era. People want to believe they are living in a special time. It flatters us. It makes our investments feel like destiny rather than risk. They didn't have this back then. Of course, the old rules don't apply. Second, the power of social proof. When everyone around you is doing the same thing and making money, it's incredibly hard to stand apart. You don't want to be the idiot who missed the greatest opportunity of a generation. Doubt turns into shame. Caution looks like cowardice. Third, the anesthesia of easy money. When you make more in a week on a speculative bet than in a month of honest work, your brain quietly rearranges its values. Boring effort feels stupid. Quick, leveraged gains feel smart. You stop asking, "Is this sustainable?" and start asking, "How do I get more of this?" This is why bubbles often recruit not the most ignorant but the half-educated. People who know just enough about tech or finance or macroeconomics to build clever narratives, but not enough to see where their own incentives are blinding them. So, if the pattern is always the same, is every boom a bubble? Of course not. Real progress exists. The internet was real. Railroads transformed economies. Electrification changed everything. Some tech stocks today will be the giants of tomorrow. The danger is not progress. The danger is when price rises detach from reality and start to feed mainly on their own momentum. How can you tell the difference? History doesn't give perfect formulas, but it does whisper a few consistent warning signs. When skeptics are mocked, not debated. When every conversation about the asset ends with, "You just don't get it." When borrowing to participate becomes normal, even encouraged. When metrics drift from simple, grounded measures like profits, cash flow, rent, dividends, to vague abstractions like eyeballs, users, or total addressable market, with no path to capture it. When people who have never cared about finance before suddenly become experts on that one asset. When the people closest to the underlying business quietly cash out while telling the public to hold on. That's when history starts to smile bitterly. One of the cruelest features of bubbles is this. They often feel safest exactly when they are most dangerous. At the peak, volatility may actually be low. Everyone seems to agree on the narrative. Headlines are universally positive. Friends who have been right for months or years feel bulletproof. The absence of visible danger is itself a danger. Then some event, often not that big in isolation, becomes a match to the dry tinder. A missed earnings report, a regulatory rumor, a sudden shift in interest rates, a single failed auction or fund collapse. The match is not the true cause. It's just the first thing everyone can point at. The true cause is the accumulated fragility. Too much leverage, too little skepticism, too many people sitting on gains they don't want to lose, too many promises that only work in straight-up charts. When the first sellers move and don't find buyers at the old prices, everyone else suddenly remembers an emotion they've been suppressing. Fear. Fear travels faster than greed. That is why bubbles don't deflate gently. They burst. They crash. They seize. Look at a long-term chart of tulip prices, or South Sea shares, or the NASDAQ in 2000, or U.S. housing-related assets in 2007-2009. The rise is usually gradual, accelerating toward the top. The fall is brutal, almost vertical. So what can you do? At a personal level, you can't control market cycles. You can't stop bubbles. You can't single-handedly change human nature. But you can do one thing that almost no participant in any bubble does in real time. You can remember the pattern. When you feel that pull, that mixture of excitement and anxiety, that sense that everyone is making easy money but me, you can pause and ask, what is the actual thing here? Is there real cash flow, real utility, real productivity behind this? Or is the main driver what other people believe they can sell it for next month? How much of the current price is justified by reality, and how much is just the shadow of someone else's expectations? How much leverage is hiding in this story? Not just yours, but the system's. What happens if the narrative changes and this thing trades 50% lower? Who gets wiped out? Who is forced to sell? Are you quietly counting on their forced selling not happening? Those are not bearish questions. They are survival questions. History shows that some of the greatest fortunes were made not by the people who rode bubbles the highest, but by those who participated with eyes open, took gains, and stepped aside when the party turned into a stampede. And some of the greatest regrets come from people who looked back and said, I knew, deep down, that it didn't make sense, but I was afraid of looking stupid. From tulips to tech stocks, every bubble has two audiences. The people in the arena, shouting and gesturing as the bids fly, and the people sitting in the balcony, watching, curious, but not hypnotized. You don't have to live your financial life in the arena all the time. You can step back, study the old scripts, and recognize when the dialogues start to sound rehearsed. This time is different. The old rules don't apply. Everyone is doing it. You can't lose. You're missing out. Don't be negative. The costumes change. The script is almost identical. Tulip traders never imagined they were writing a manual for the dot-com boom. Dot-com investors never thought they were rhyming with 1929. Home flippers in 2006 didn't see themselves in Dutch taverns bidding on flowers. Yet in the long light of financial history, they all look like actors on the same stage. The next bubble will not be about tulips, or railways, or radio, or dot-coms, or subprime mortgages. It will attach itself to whatever story feels the most exciting, inevitable, and painless at the time. Maybe a new technology, maybe a new form of money, maybe something we haven't even named yet. It will have different jargon, different influencers, different platforms. People will say, again, that the old examples don't apply. Financial history quietly disagrees. Every bubble looks different. Every bubble feels unique. Every bubble tells its participants, you're living in a special time. And every bubble, when you strip away the marketing and the memes, ends the same way. When the story can no longer stretch to justify the prices, the belief breaks. When belief breaks, credit shrinks. When credit shrinks, prices fall faster than anyone thinks possible. And in the wreckage, people tell themselves, as they always have, no one could have seen this coming. But if you've studied the path from tulips to tech stocks, you know that's not quite true. The signs were there. They're always there. The question is whether we want to see them before the ending, or only after the credits roll.